Question 1. Which of the following statements is true regarding a joint tenants with right of survivorship, JTWROS, account? A. Upon the death of one tenant, their share passes to their estate. B. All tenants must agree to every trade placed in the account. C. Ownership of the account passes automatically to the surviving tenants upon the death of one tenant. D. It permits unequal ownership percentages among the tenants. Answer: C. Ownership of the account passes automatically to the surviving tenants upon the death of one tenant. Explanation: a JTWROS account is characterized by the right of survivorship, meaning that upon the death of one tenant, their share of the account's assets automatically passes to the surviving tenants without going through probate. This feature ensures a smooth transfer of ownership and avoids potential delays and expenses associated with estate settlement. This differs significantly from tenants in common (TIC), where the deceased share goes to their estate, making JTWROS a common choice for spouses. Question 2. An investor owns 100 shares of XYZ stock and sells one XYZ call option. This option strategy is known as a long straddle. B. Covered call. C. Naked call. D. Protective put. Answer B. Covered call. Explanation: selling a call option when already owning the underlying stock is known as a covered call. The shares owned cover the obligation to deliver the stock if the call option is exercised. This strategy generates income from the premium received while limiting potential upside gain on the stock, and it carries less risk than a naked, uncovered call because the obligation can be met. Question 3. Interest income from municipal bonds is typically exempt from A. Federal income tax only. B. State and local income tax only. C. Federal income tax and for residents of the issuing state, state and local income tax. D. All taxes for all investors regardless of residency. Answer: C. Federal income tax and for residents of the issuing state, state and local income tax. Explanation: interest income from municipal bonds is generally exempt from federal income tax. Additionally, if the bondholder is a resident of the state that issued the bond, the interest income is also typically exempt from state and local income taxes. This triple tax exemption is a significant advantage for investors in high tax brackets, but it's important to remember that capital gains on municipal bonds are still taxable. Question 4. Which of the following activities takes place in the secondary market? A. A corporation issuing new shares of stock through an initial public offering (IPO). B. An investor purchasing shares of a mutual fund directly from the fund company. C. A broker-dealer facilitating the sale of previously issued bonds between two investors. D. A municipality selling newly issued general obligation bonds to finance public projects. Answer: C. A broker-dealer facilitating the sale of previously issued bonds between two investors. Explanation: the secondary market is where previously issued securities are traded between investors. Activities like an IPO or a municipality selling new bonds occur in the primary market, where securities are first issued. When a broker-dealer helps two investors exchange existing bonds, it is a quintessential secondary market transaction, facilitating liquidity for outstanding securities. Question 5. According to FINRA Rule 2210, a broker-dealer's retail communication that is distributed to 25 or more retail investors within any 30 calendar day period must generally be A. Filed with FINRA 10 business days after first use. B. Approved internally by a principal before first use. C. Filed with FINRA 10 business days before first use. D. Exempt from filing if it only promotes educational material. Answer B. Approved internally by a principal before first use. Explanation: FINRA Rule 2210 requires that all retail communications be approved internally by a qualified principal of the firm before first use. Certain types of retail communications, particularly those for new firms or those concerning investment companies, may also require filing with FINRA. However, principal approval is a fundamental prerequisite for ensuring the content is fair, balanced, and compliant with regulatory standards. Question 6. The net asset value, NAV, of an open-end management company, mutual fund, is calculated A. Daily at the close of the New York Stock Exchange, NYSE. B. Weekly at the start of trading on Monday. C. Only when shares are redeemed by investors. D. Continuously throughout the trading day like a stock. Answer A. Daily at the close of the New York Stock Exchange, NYSE. Explanation. The net asset value, NAV, of an open-end mutual fund is calculated once per day, typically at the close of the New York Stock Exchange, 4 p.m. Eastern Time. Orders to buy or sell mutual fund shares are processed at the next calculated NAV. This forward pricing mechanism ensures fairness for all investors, as everyone buying or selling on a given day receives the same price. Question 7. Churning is an unethical practice defined as A. Executing trades without proper client authorization. B. Failing to disclose all material facts to a client before a trade. C. Excessive trading in a customer's account primarily to generate commissions for the registered representative. D. Recommending unsuitable investments to a client based on their risk profile. Answer C. Excessive trading in a customer's account primarily to generate commissions for the registered representative. Explanation. Churning refers to the unethical and illegal practice of excessive trading in a client's account, not for the benefit of the client, but primarily to generate commissions for the registered representative. This practice violates FINRA suitability rules and fiduciary duties. Registered representatives must always prioritize the client's interests and ensure that trading activity is appropriate for their financial goals and risk tolerance. Question 8. According to Regulation T, Reg T, the initial margin requirement for purchasing common stock is generally A. 25% of the market value. B. 50% of the market value. C. 75% of the market value. D. 100% of the market value. Answer B. 50% of the market value. Explanation. Regulation T, established by the Federal Reserve Board, dictates that the initial margin requirement for purchasing common stock is generally 50% of the market value. This means an investor must deposit at least 50% of the purchase price, borrowing the remainder from the broker-dealer. This requirement helps to control speculative activity and manage risk in margin accounts, though some firms may set higher house requirements. Question 9. When determining the suitability of an investment for a client, which of the following is considered the most important factor? A. The client's age. B. The client's investment objective and risk tolerance. C. The client's current income level. D. The client's previous investment experience. Answer B. The client's investment objective and risk tolerance. Explanation. While all factors listed are important for suitability, the client's investment objective and risk tolerance are considered the most critical. These factors directly inform what types of investments align with the client's goals and comfort level with potential losses. Without understanding these, other demographic or financial details cannot effectively guide investment recommendations, making this the foundational element of a suitability determination. Question 10. An investor buys one XYZ April 50 call for a premium of 3. What is the break-even point? 47. B. 50. C. 53. D. 56. Answer C. 53. Explanation. To find the break-even point for a long call option, you add the premium paid to the strike price. In this case, the strike price is 50 and the premium is 3. Therefore, 50 plus 3 is equal to 53. The investor needs the stock price to reach $53 per share at expiration for the option to cover its cost and for the investor to begin profiting. Question 11. General obligation Go. Bonds are backed by A. Revenues from a specific project or facility. B. The full faith, credit, and taxing power of the issuing municipality. C. Private corporations' lease payments. D. Fees collected from users of public utilities. Answer B. The full faith, credit, and taxing power of the issuing municipality. Explanation. General obligation Go. Bonds are backed by the full faith, credit, and taxing power of the issuing municipality. This means that the issuer pledges its entire tax base and, if necessary, its ability to raise taxes to repay the bondholders. Unlike revenue bonds, Go bonds are not tied to specific project revenues, making them generally considered less risky due to the broad backing of the issuer's governmental authority. Question 12. A key difference between an exchange-traded fund (ETF) and an open-end mutual fund is that ETFs A. Are always actively managed while mutual funds are always passively managed. B. Are purchased and sold on an exchange throughout the day at market-determined prices. C. Calculate their net asset value, NAV, only once per week. D. Do not charge management fees. Answer B. Are purchased and sold on an exchange throughout the day at market-determined prices. Explanation. A primary distinction is that ETFs trade like stocks on exchanges throughout the day, with their prices determined by supply and demand, potentially differing from their NAV. Open-end mutual funds, conversely, are priced once daily at their NAV at the end of the trading day. While both charge management fees and can be actively or passively managed, the intraday trading liquidity is a hallmark of ETFs. Question 13. A durable power of attorney differs from a regular power of attorney in that it A. Can only be granted to a family member. B. Remains in effect if the grantor becomes incapacitated. C. Is revoked automatically upon the grantor's death. D. Requires court approval before any transactions can be executed. Answer B. Remains in effect if the grantor becomes incapacitated. Explanation. A durable power of attorney is specifically designed to remain in effect even if the grantor becomes mentally or physically incapacitated. A regular power of attorney, however, becomes void upon the grantor's incapacitation. Both types are automatically revoked upon the grantor's death, and neither typically requires court approval for transactions, although proper documentation with the financial institution is essential. Question 14. An individual who has access to material non-public information and uses it to trade securities is guilty of structuring. B. Front-running. C. Insider trading. D. Free riding. Answer C. Insider trading. Explanation. Insider trading involves the illegal practice of using material, non-public information to make personal profit from securities transactions. This undermines the fairness and integrity of the financial markets. Such actions are strictly prohibited by the Securities Exchange Act of 1934 and can result in severe civil and criminal penalties, including large fines and imprisonment. Question 15. A put option gives the holder the right to A. Buy the underlying security at the strike price. B. Sell the underlying security at the strike price. C. Receive dividends from the underlying security. D. Exercise the option only at expiration. Answer B. Sell the underlying security at the strike price. Explanation. A put option provides the holder with the right, but not the obligation to sell the underlying security at a specified price, the strike price, on or before the expiration date. This option contract is typically bought by investors who expect the price of the underlying security to decline. The right to buy is characteristic of a call option, not a put. Question 16. Inflation generally has what effect on bond prices and interest rates? A. Bond prices increase, interest rates decrease. B. Bond prices decrease, interest rates increase. C. Bond prices and interest rates both increase. D. Bond prices and interest rates both decrease. Answer B. Bond prices decrease, interest rates increase. Explanation. When inflation increases, the purchasing power of future fixed interest payments and principal repayment from bonds decreases. To compensate for this loss of purchasing power, investors demand higher yields, causing interest rates to rise. Consequently, existing bonds with lower fixed coupon rates become less attractive, leading to a decrease in their market prices as new bonds offer higher yields. Question 17. Which of the following statements about real estate investment trusts, REITs, is true? A. REITs are direct participation programs, DPPs. B. REITs are typically illiquid investments. C. REITs pass through gains but not losses to investors. D. REITs distribute at least 90% of their taxable income to shareholders. Answer. D. REITs distribute at least 90% of their taxable income to shareholders. Explanation. REITs are companies that own, operate, or finance income-producing real estate. To qualify for special tax treatment and avoid corporate taxation, REITs are required by law to distribute at least 90% of their taxable income to shareholders annually. They trade on exchanges offering liquidity and are not considered direct participation programs (DPPs), nor do they pass through losses. Question 18. In a firm commitment underwriting, the risk of unsold shares is borne by the A. Issuer, B. Underwriting syndicate, C. Selling group, D. Broker-dealer selling group members. Answer B. Underwriting syndicate. Explanation. In a firm commitment underwriting, the underwriting syndicate agrees to purchase all the shares from the issuer and then resell them to the public. This means the syndicate bears the financial risk of any unsold shares. If the offering is not fully subscribed, the underwriters are still obligated to pay the issuer for the entire issue, making it the most significant risk for the underwriters. Question 19. The Municipal Securities Rulemaking Board, MSRB, regulates issuers of municipal securities, B. Broker-dealers, banks and municipal advisors involved in municipal securities, C. Only municipal bond rating agencies, D. Only broker-dealers trading corporate bonds. Answer B. Broker-dealers, banks and municipal advisors involved in municipal securities. Explanation. The MSRB is a self-regulatory organization, SRO, that creates rules for municipal securities firms and professionals. It regulates the activities of broker-dealers, banks and municipal advisors involved in the municipal securities market, but it does not regulate municipal issuers themselves. Its primary role is to protect investors and maintain fair practices in the municipal market. Question 20. A transfer on death (TOD) designation on an account allows A. The account to be managed by a trustee for beneficiaries, B. Assets to pass directly to a named beneficiary upon the owner's death, bypassing probate, C. The account owner to make gifts to beneficiaries during their lifetime, D. The account to be jointly owned with another individual. Answer B. Assets to pass directly to a named beneficiary upon the owner's death, bypassing probate. Explanation. A transfer on death (TOD) designation allows the owner to name specific beneficiaries who will receive the assets in the account directly upon the owner's death, without the need for probate. This simplifies the asset transfer process and helps avoid delays and expenses associated with a will. It is a common feature for individual accounts and is distinct from trust accounts or joint accounts. Question 21. What is the maximum potential loss for an investor who buys one XYZ October 50 put for a premium of 4? Unlimited. B. The strike price of 50. C. The premium paid, which is 4. D. The strike price minus the premium, which is 46. Answer. C. The premium paid, which is 4. Explanation. When an investor buys an option, the maximum potential loss is always limited to the premium paid for that option. In this scenario, the investor paid a premium of 4 for the put option. If the option expires worthless, i.e. the stock price is above 50 at expiration, the investor loses only the $400 4 by 100 shares premium, as they would simply not exercise the option. Question 22. Which of the following statements is true regarding the financing and risk profile of revenue bonds? A. They are backed by the general taxing power of the issuing municipality, similar to GO bonds. B. A feasibility study is often required before issuance to assess the project's ability to generate sufficient income to cover debt service. C. They are generally considered less risky than general obligation bonds due to their specific project backing. D. Their interest payments are guaranteed by the federal government, making them risk-free. Answer. B. A feasibility study is often required before issuance to assess the project's ability to generate sufficient income to cover debt service. Explanation. Revenue bonds are municipal bonds whose debt service is paid from the revenues generated by the specific project they finance. Because they are not backed by the general taxing power of the municipality, a feasibility study is typically required before issuance. This study assesses the economic viability and revenue-generating potential of the project, e.g., tolls, user fees, to ensure it can cover the bond's principal and interest payments, highlighting the project-specific risk inherent in revenue bonds. Question 23. A direct participation program (DPP) offers investors A. Shares that trade on a national exchange. B. Active management by a general partner with limited liability. C. Pass-through of income and losses to investors, avoiding corporate taxation. D. Guaranteed returns due to specific tax benefits. Answer: C. Pass-through of income and losses to investors, avoiding corporate taxation. Explanation: direct participation programs (DPPs), such as limited partnerships, are characterized by the pass-through of income, deductions, and credits directly to the investors. This means the program itself avoids corporate-level taxation, and investors include their share of the DPP's profits and losses on their individual tax returns. DPPs are generally illiquid and carry significant risks, offering no guarantees of return. Question 24. State securities laws are commonly referred to as A. Federal Reserve Regulations. B. Blue Sky Laws. C. FINRA Rules. D. Sarbanes-Oxley Acts. Answer B. Blue Sky Laws. Explanation: state securities laws are commonly known as blue sky laws. These laws are designed to protect investors from fraudulent sales practices and schemes, particularly regarding speculative investments. Each state has its own set of blue sky laws, and they generally require the registration of securities, broker-dealers, and agents before they can sell securities within that state. Question 25. An account is considered restricted when the equity in the account is A. Above the initial margin requirement. B. Below the initial margin requirement but above the maintenance margin. C. Below the maintenance margin requirement. D. Equal to the debit balance. Answer: B. Below the initial margin requirement but above the maintenance margin. Explanation: a margin account becomes restricted when the equity in the account falls below the initial Regulation T margin requirement, e.g. 50%, but remains above the maintenance margin requirement, e.g. 25%. While restricted, the account holder cannot make new purchases on margin without depositing additional funds. However, no margin call is issued unless the equity falls below the maintenance level. Question 26. A client with a low risk tolerance and a need for income would most likely be suited for which of the following investments? A. Growth stocks. B. Speculative options. C. High-yield corporate bonds. D. Short-term municipal bonds. Answer: D. Short-term municipal bonds. Explanation: for a client with low risk tolerance and a need for income, short-term municipal bonds are generally a suitable choice. They offer relative safety due to their shorter maturity and often government backing, and their interest income is typically tax-exempt at the federal level and potentially state/local. Growth stocks and speculative options are too risky, and high-yield corporate bonds carry significant credit risk. Question 27. A tombstone advertisement placed by an underwriter can include all of the following except A. The name of the issuer. B. The type of security being offered. C. The public offering price. D. An indication of interest form. Answer: D. An indication of interest form. Explanation: a tombstone advertisement is a simple announcement of a security offering and is not considered an offer to sell. It can include factual information such as the issuer's name, security type, public offering price, and names of the underwriters. However, it cannot include an indication of interest form or any language that could be construed as soliciting an offer to buy, as this would make it a prospectus requiring more detailed disclosures. Question 28. Selling away refers to a registered representative. A. Selling proprietary products of their own firm to clients. B. Executing trades in a customer's account without discretionary authority. C. Engaging in private securities transactions without providing written notice to their employing broker-dealer. D. Recommending investments that are unsuitable for a client's risk profile. Answer: C. Engaging in private securities transactions without providing written notice to their employing broker-dealer. Explanation: selling away occurs when a registered representative sells securities to clients that are not offered or approved by their employing broker-dealer, without first providing written notice to and obtaining written permission from their firm. This practice violates FINRA rules as it exposes both the firm and clients to undisclosed risks. It is a serious ethical and regulatory breach, often leading to disciplinary action. Question 29. An American-style option can be exercised A. Only on the expiration date. B. At any time up to and including the expiration date. C. Only after the stock price moves beyond a certain percentage. D. Only during specific hours on the expiration date. Answer: B. At any time up to and including the expiration date. Explanation: American-style options provide the holder with the flexibility to exercise the option at any point between the purchase date and the expiration date. This contrasts with European-style options, which can only be exercised on the expiration date itself. The ability to exercise early makes American-style options generally more valuable than European-style options, all else being equal. Question 30. The official statement for a municipal bond offering is comparable to which document for corporate securities? A. An annual report, 10K. B. A preliminary prospectus, red herring. C. A proxy statement. D. A research report. Answer: B. A preliminary prospectus, red herring. Explanation: The official statement for a municipal bond offering is the primary disclosure document provided to potential investors, containing detailed information about the bond's terms, the issuer's financial condition, and the project being funded. It serves a similar purpose to a prospectus or preliminary prospectus, red herring, for corporate securities, providing essential information to help investors make informed decisions. Question 31. Which characteristic is unique to a unit investment trust (UIT) compared to a mutual fund? It is always actively managed. B. Its portfolio is fixed and generally unmanaged once established. C. Its shares trade on an exchange throughout the day. D. It charges a performance fee based on returns. Answer: B. Its portfolio is fixed and generally unmanaged once established. Explanation: A distinguishing feature of a unit investment trust (UIT) is that it has a fixed portfolio of securities that is generally unmanaged and remains unchanged throughout the trust's life. This contrasts with mutual funds, which are actively managed, or passively managed but rebalanced, and have portfolios that change over time. UITs also have a specified termination date, unlike open-end mutual funds which are perpetual. Question 32. For a registered representative to exercise discretion in a customer's account, which of the following is required? A. An oral authorization from the customer for each discretionary trade. B. Written authorization from the customer and approval by a principal of the firm. C. Only verbal consent from the customer before each trade. D. No specific authorization as long as the trades are suitable. Answer: B. Written authorization from the customer and approval by a principal of the firm. Explanation: To exercise discretionary authority in a customer's account, a registered representative must obtain written authorization from the customer. Additionally, this discretionary account must be formally approved by a qualified principal of the broker-dealer firm. Oral authorization is not sufficient for discretionary trading, emphasizing the seriousness and regulatory scrutiny of such trading privileges. Question 33. A shelf registration allows an issuer to A. Delay the release of financial statements indefinitely. B. Register securities that can be offered and sold over a period of up to 3 years. C. Issue securities without any disclosure documents. D. Offer securities only to accredited investors. Answer: B. Register securities that can be offered and sold over a period of up to 3 years. Explanation: A shelf registration permitted under SEC Rule 415 allows a single registration statement to be filed for securities that can be offered and sold off the shelf over a period of up to 3 years. This provides issuers with flexibility to quickly access the capital markets when conditions are favorable, without needing to file a new registration each time. It requires that the issuer be a well-established company with a history of reporting to the SEC. Question 34. Under the Bank Secrecy Act, a suspicious activity report, SAR, must be filed with FinCEN within how many days of the discovery of the suspicious activity? A. 5 business days. B. 10 calendar days. C. 30 calendar days. D. 60 calendar days. Answer: C. 30 calendar days. Explanation: financial institutions including broker-dealers are required to file a Suspicious Activity Report, SAR, with the Financial Crimes Enforcement Network, FINCEN, within 30 calendar days of becoming aware of suspicious activity. This is a critical component of anti-money laundering (AML) efforts. The filing of a SAR must remain confidential and cannot be disclosed to the individual involved in the suspicious activity. Question 35. Which of the following option strategies involves writing a put option against a short position in the underlying stock? A. Covered call. B. Protective put. C. Covered put. D. Long straddle. Answer: C. Covered put. Explanation: writing a put option against a short position in the underlying stock is known as a covered put. In this strategy, the short stock position acts as the cover for the obligation to buy the stock if the put option is exercised. The investor collects the premium from writing the put, which can partially offset potential losses if the stock price rises, but the primary risk comes from the short stock position.